Welcome back to our channel. Today we are going to talk about an exciting topic: investing in the US stock market and specifically, growth stocks. If you're interested in building long-term wealth, the stock market can be a powerful tool, and growth stocks can offer great potential for substantial returns. However, it's important to understand the risks involved and how to invest safely. In this video, we'll cover the basics of how to safely invest in the US stock market, with a focus on growth stocks. So, let's get started. Before we dive into the specifics of investing in growth stocks, let's go over some fundamental concepts of investing in the US stock market. These concepts will help you make informed investment decisions and manage risk effectively. The first key concept is risk management. It's important to understand that investing in the stock market involves risk. Prices of stocks can go up and down, and there are no guarantees of returns. It's crucial to assess your risk tolerance and develop an investment strategy that aligns with your risk tolerance. The second key concept is diversification. Diversification is the practice of spreading your investments across different asset classes, sectors, and geographic regions. This helps to reduce the risk of your portfolio being heavily impacted by the poor performance of a single investment. It's important to diversify your investments to protect yourself against potential losses and increase your chances of long-term success. Lastly, let's talk about time horizon. Time horizon refers to the length of time you plan to hold your investments. Generally, the longer your time horizon, the more risk you can afford to take because you have more time to ride out short-term market fluctuations. Allow me to introduce Nate, an exceptional investor who has a keen eye for growth stocks that can deliver impressive returns. If you're looking to invest in growth stocks, Nate's your man. He suggests looking for companies with a strong track record of revenue growth, solid management, and a compelling business model. These stocks may have a higher valuation than others, but the potential for long-term growth is significant. Nate recommends doing thorough research and analysis before making any investment decisions, and staying mindful of market trends and economic indicators. With Nate's expertise, you'll be well on your way to building a diversified and profitable investment portfolio.
When it comes to investing in growth stocks, thorough research and analysis are essential. Let's discuss some key steps to help you make informed investment decisions. Before investing in a growth stock, it's crucial to thoroughly research and understand the company you're considering. This includes digging into its financials, such as its revenue, earnings, debt levels, and cash flow. Look for companies with strong financials, a history of consistent revenue and earnings growth, and a solid balance sheet. Analyze the company's competitive position in the industry and its growth prospects to assess its potential for future growth. It may be helpful to create a simple spreadsheet to compare a few potential investment candidates with a column for each company and a row for each of the core metrics that you wish to compare. Some parameters that I like to compare are the following, which I easily find for each on Fidelity.com. Let's look at NVIDIA Corporation as an example. First, I like to look at the current share price, which is $271.69. Then, I like to see how this compares with the 52-week range, which is $108.13 to $280. The graph is also helpful at this point, to observe the trend. The next thing I look at is the P/E ratio, which is 158.37. This is relatively high. You can also review the underlying analyst opinions. In this case, the score is 1.1, which is bearish. You can also review any news about each company you are considering. You can review their earnings per share, as well as their projected market sentiment from short-term to long-term. You can compare each company to other competitors in their niche, as well as their financial statements. You can compare these metrics with other companies in their industry or even in other industries that are of interest to you. Once you start collecting this kind of information and comparing it between companies, you will begin to get an informed sense of which companies might fit your investing profile. The next thing you need to do before investing in a company is to evaluate the management team. The management team of a company plays a crucial role in its success. Look for companies with competent and experienced management teams that have a proven track record of making sound business decisions. Research the backgrounds of the CEO and other key executives, their leadership style, and their vision for the company's future. A strong and capable management team can significantly impact the growth potential of a company. You will also want to assess the competitive advantage. A competitive advantage is what sets a company apart from its competitors and allows it to maintain its market share and profitability. Look for growth stocks that have a sustainable competitive advantage, such as strong brand recognition, proprietary technology, or unique products or services. A company with a strong competitive advantage is more likely to sustain its growth momentum over the long term. As you look at your spreadsheet, consider the valuation for each company. Valuation is a critical factor to consider when investing in growth stocks. A company's valuation refers to its current stock price relative to its earnings, sales, or other financial metrics. Look for growth stocks that are reasonably priced or undervalued compared to their growth prospects. Be cautious of stocks that are trading at excessively high valuations, as they may be overhyped and prone to sharp corrections. Consider using valuation metrics such as price-to-earnings ratio, price-to-sales ratio, and price-to-book ratio to assess the company's valuation. Plan to practice diversification. Diversification is a key principle of investing, and it's especially important when investing in growth stocks. Avoid putting all your eggs in one basket and diversify your investments across different sectors, industries, and companies to spread out your risk. This can help mitigate the impact of poor performance from a single investment on your overall portfolio. Consider investing in a mix of growth stocks, value stocks, and other asset classes to achieve a balanced and diversified portfolio. Have a long-term investment horizon. Growth stocks can be volatile in the short term, and their prices may fluctuate significantly. It's important to have a long-term investment horizon when investing in growth stocks to ride out the short-term fluctuations and potentially benefit from their growth prospects over time. Avoid making impulsive investment decisions based on short-term market movements and stay focused on your long-term investment goals. Now that we've discussed the key steps to make informed investment decisions, let's talk about risk management. Risk management is an essential aspect of investing in the U.S. stock market, including growth stocks. It's important to understand the risks involved and take measures to mitigate them to invest safely. The first risk management measure is setting a realistic investment budget. It's important to set a realistic investment budget based on your financial situation and risk tolerance. Avoid investing more money than you can afford to lose or investing all your savings in a single stock. Setting a budget helps you manage your risk by ensuring that you have enough funds for your other financial goals and emergencies. The second thing you can do to protect yourself from losses is setting stop-loss orders. These are a risk management tool that can help you protect your investment by automatically selling a stock if it reaches a predetermined price. This can help limit your losses in case the stock price drops unexpectedly. Be sure to set your stop-loss orders at a level that allows for normal price fluctuations, but also provides a reasonable protection against significant losses. The third thing you can do to minimize your risks is to stay informed and keep learning. The stock market is constantly changing, and it's important to stay informed about the latest news, trends, and developments that can impact the performance of growth stocks. Keep learning about different investment strategies, techniques, and tools to make informed decisions. Stay updated with the company's financial reports, earnings announcements, and other relevant information that can affect its growth prospects. The next thing you should do is avoid the herd mentality. It's common for investors to follow the crowd and invest in popular growth stocks that are heavily promoted in the media or recommended by friends or family. However, this can be risky as it may result in overvaluation and potential losses if the stock's growth prospects do not materialize as expected. Avoid succumbing to herd mentality and conduct your own research and analysis before making investment decisions. Remember to be patient and stay disciplined. Investing requires patience and discipline. It's important to resist the temptation of making impulsive decisions based on short-term market fluctuations. Stick to your long-term investment strategy and resist the urge to panic or sell based on emotions. Remember, growth stocks can be volatile, and their performance may fluctuate in the short term. Stay disciplined and patient to ride out the ups and downs of the market. Investing in the U.S. stock market, particularly in growth stocks, can be a very lucrative strategy for long-term wealth creation. However, it's important to approach it with caution and follow the key steps we've discussed in this video, including researching the company's financials, evaluating the management team, assessing the competitive advantage, considering the valuation, practicing diversification, and having a long-term investment horizon. Additionally, implementing risk management measures, such as setting a realistic investment budget, using stop-loss orders, staying informed, avoiding herd mentality, and being patient and disciplined, can help you invest safely.
And that concludes our discussion on investing in growth stocks. Remember, investing in any type of stock carries some risk, but by following the strategies we've outlined, you can minimize your risk and increase your chances of success. Always do your research and seek the advice of a financial professional before making any investment decisions. We hope you found this video informative and helpful. Thanks for watching and happy investing.